Hello, my friends, and welcome back to another episode of P&T Smart Minds. Today, we will be looking into the market structure in forex trading. It is very important to know the market structure before starting any trade. Note that this is one of the crucial elements in trading. It is very important for price action traders, and it is the initial key step that every trader must take when learning to trade. Now, many traders face losses in their failure to properly identify and understand the market structure. Only very few traders have a proper idea of market structure. So, in this episode, we will explain the basic concepts of market structure that are essential for every trader to understand and apply in their trading journey. Now let's look at these essential topics very well to help you get better in forex trading. Bearish or downtrend. A bearish or downtrend is characterized by a series of lower highs and lower lows on a price chart. In a downtrend, sellers are in control, pushing the price lower as they outnumber buyers. Traders typically look to sell or short sell in a downtrend, aiming to profit from further price declines. Downtrends can be identified by connecting the swing highs and lows with a trend line sloping downward. Bullish or uptrend. A bullish or uptrend is marked by a series of higher highs and higher lows on a price chart. In an uptrend, buyers dominate the market, pushing prices higher as demand outweighs supply. Traders in an uptrend usually seek to buy or go long, aiming to capitalize on upward price movements. Uptrends can be identified by connecting the swing lows and highs with an upward sloping trend line. Consolidation. Consolidation, also known as ranging or sideways market, occurs when the price moves within a relatively narrow range without forming clear higher highs or lower lows. During consolidation, the market is in equilibrium, with neither buyers nor sellers having significant control. Traders often avoid trading during consolidation periods as the lack of clear trend direction makes it challenging to predict price movements accurately. Consolidation phases can be identified by horizontal support and resistance levels, where the price bounces between these levels without making significant progress in either direction. Understanding these different market conditions is essential for forex traders as it helps them adapt their strategies accordingly. Traders may employ different techniques and indicators depending on whether the market is trending, bullish or bearish, or consolidating. These two topics have to be considered for a proper understanding of market structure. 1. Break of structure. 2. The change of character. 1. Break of structure. What then is the break of structure? It is often defined as a situation where the price breaks a high to the upside. Now, there are some conditions to be considered when checking for a proper break of structure. 1. A valid break of structure occurs when the price breaks above the most recent higher. Please consider that its candle body should be higher than the recent high. Therefore, a new minimum low and maximum high is considered. It is important to identify a valid maximum, high or low, as this enables us to find a trend signal for a trend reversal or continuous in the market. The first type of trend we discussed was a straightforward trend, but trends are not always like this. Some are more complicated, so let's dive into this type of trend. There is a risk of falling into traps if the trends are not properly analyzed. Now let's consider some very important points. 1. As we said before, it is important to know a valid maximum high and the lowest low that created that high. Let's see an example of how that looks. This is more realistic. You can see that the price breaks the previous high to the upside. How do we know a valid break of structure? Let's check this out. You can see that the price started going up to some extent. This was its highest high at that time, and it then went down to the lowest point before changing direction again. So this first high is taken as the highest high and the low as the major low, or the lowest low at this time. It now goes up to a higher high that is higher than the previous high. You can see that it is only the highest high and the lowest low that created this high that is considered valid. It is important to note that only the lowest and highest points are valid in the trend. Those smaller and internal points are not valid and cannot be used to determine the direction of the trend. Also, the highest high that brought the last low has been surpassed by a new high. It confirmed the trend's continuity to the upside is still on. If the last low is taken out, then it is a reversal of the trend. Without the last low being taken out, the trend cannot be taken as a reversal. It would still be taken as an uptrend or continuity to the upside. Before we continue with our teaching, please subscribe for more valid content, and also where required, place comments to help us know that you are enjoying the content. Now let's continue our teaching. Let's consider a bearish break of structure, which is on the downside, with the highest point leading to the break of structure. This now produces a major low, leading to a break of structure. This brings about a highest high and a major low. Some smaller prices that were created in between. These are called internal structures. When the price breaks the major low to the upside, this information creates the highest high, which makes this trend a continuous one. This confirms that the bearish trend continues. Now, if the price rises above the highest high as shown here, we should take it as a sign of reversal. Please note that it must have broken the highest high. This would confirm that it is no longer a bearish trend. Now, this leads us to another market structure called change of character. It is very important to always know the market direction of a trend. We need to know if it is an uptrend or a downtrend. It is very important to know the break of structure and where it occurs on the price chart. The change of character occurs when a trend is moving in a specific direction or following a specific trend. And then a reversal takes place, which breaks a specific major high or major low. When this occurs, we say it has made a change of character. A change of character is checked when trading a price chart to know when the trend is going in the opposite direction. Let's now go to the chart for more clarity. Now, from the chart, we can see that this is a bearish trend. The line is heading downwards and the trend is making a lower low and a lower high. So traders, this confirms a bearish trend. How do we know when it has changed character? We have to constantly check that the break of structure is continuing at every low it makes. When a change of character takes place, we can know. Before we continue with our teaching, please subscribe for more valid content, and also where required, place comments to help us know that you are enjoying the content. Note that a change of character occurred when the last lower high was broken and a reversal was made. This caused a bullish or an uptrend to be created. This is what is called a change of character. Let's work with another real example using a bullish trend. Now we know it was a bullish trend because the price was making a higher low and a higher high. Please note that it was still making a valid break of structure, creating a major high, until it got to a level where the price could not create more high, creating almost an equal high. This area could be assumed to be an overbought level. At such points, traders would try to check for a change of character, which can be a reversal signal. Identifying when a trend in forex trading is exhausted and likely to reverse involves a combination of technical analysis indicators, price action patterns, and market sentiment analysis. Here are some common methods traders use to detect potential trend reversals. 1. Support and resistance levels. When a price approaches a significant support or resistance level and fails to break through it, it could signal a potential reversal. Traders look for key levels where price has historically reversed direction. 2. Candlestick patterns. Reversal candlestick patterns such as doji, hammer, shooting star, engulfing patterns, etc., can indicate a potential shift in momentum. These patterns are often used in conjunction with other technical indicators for confirmation. 3. Overbought, oversold conditions. Oscillator indicators like RSI or stochastic. Oscillator can indicate when a currency pair is overbought or oversold. If the price remains in overbought or oversold territory for an extended period, it could indicate a potential reversal. 4. Trendline breaks. When a trend line that has been supporting or resisting price movements is broken decisively, it could signal a reversal. Traders often look for breaks accompanied by increased volume for confirmation. 5. Fibonacci retracement levels. Fibonacci retracement levels, such as 38.2%, 50%, and 61.8%, are used to identify potential support and resistance levels based on the Fibonacci sequence. These levels can help traders anticipate where a trend might reverse. In the world of trading, market structure refers to the different phases that a market goes through. A bullish trend is characterized by rising prices, optimism, and investor confidence. During a bullish trend, buyers outnumber sellers. On the other hand, a bearish trend is marked by falling prices, pessimism, and investor fear. In a bearish trend, sellers outnumber buyers, causing prices to drop. Consolidation is a period of indecision in the market, where prices move within a tight range. This phase occurs after a strong trend and before a new trend emerges. Understanding market structure is crucial for traders and investors to make informed decisions. By recognizing bullish, bearish trends and consolidation, one can better analyze market movements and anticipate potential opportunities. Thank you for watching our video. Don't forget to subscribe to our channel for more insights on market trends and trading strategies.